The tap takes less than a second. The approval is instant. The points notification arrives before the receipt prints. Three frictionless moments that together moved $340 from a future paycheck into a present transaction without the psychological weight of spending cash. The machine removed the friction deliberately. Behavioral research conducted across 40 years of transaction data demonstrated that friction reduces spending, and frictionlessness increases it. And the machine was designed around the research because the machine's revenue scales with the spending and the spending scales with the frictionlessness, and the frictionlessness was never a convenience feature. It was a revenue optimization. It was always a revenue optimization. The pre-approval mailer arrives on a Tuesday in a white envelope with your name printed on the outside, not addressed to resident, to you. The offer is 0% introductory APR. For 15 months, 60,000 bonus points after $4,000 in purchases in the first 90 days, and a card delivered in packaging that communicates a different quality tier than the offer it contains. You did not apply. The model applied for you. It processed your credit score, your estimated income, your zip code, your spending category profile assembled from data purchases and public records and prior card behavior, and determined that your profile matches the acquisition target with sufficient precision to justify the cost of the mailer and the $600 in welcome bonus redemption value, and the $150 to $300 in acquisition overhead. The credit score is 724. Good, by the industry's own taxonomy. Not very good, which begins at 740. Not exceptional, which begins at 800. Good, which is the tier where the cards with real rewards are accessible, and the cards designed to revolve are aggressively marketed, and the line between the two is not disclosed in the offer. The 724 was built across 7 years of on-time payments, and a car loan paid off in 2021, and a credit utilization that sits at 18% because you read somewhere that below 30% is better, and you have managed to it without knowing exactly why. The 724 is the entry ticket. The card issuer has known your score since before the mailer was printed. The score predicted something. The score predicted you. The 60,000 points require $4,000 in purchases in the first 90 days. $4,000 in 90 days is $1,133 a month, which is not an unusual spending level for a household at this income, which is why the threshold was set at $4,000 and not $8,000. Behavioral research demonstrates that cardholders who meet the welcome bonus threshold in the first 90 days are 34% more likely to carry a balance after the introductory period ends than cardholders who do not meet it. The threshold was not set at $4,000 because $4,000 is a meaningful number. It was set at $4,000 because $4,000 produces the spending behavior that predicts the revolving behavior that generates the lifetime revenue that justifies the $600 in welcome bonus cost and the $150 acquisition overhead and the weighted envelope. The 0% introductory period runs for 15 months. During the 15 months, no interest accrues on purchases. The period was not designed as a gift. It was designed as an onboarding mechanism. Cardholders who spend heavily in the introductory period establish the card as their primary spending instrument. Establishing the card as the primary instrument before the rate applies means the rate applies to an established habit rather than a new one. Established habits are harder to break than new ones. The 15 months of 0% is the cost of establishing the habit. The habit is the asset. The APR applied to the habit is the revenue. The credit limit is $8,500. The limit on a household income of $74,000 was set by a model that optimizes for maximum balance accumulation without exceeding the default probability threshold for this income segment. $8,500 is not a generosity signal. It is an inventory decision. The inventory is your borrowing capacity. The model determined that $8,500 of inventory at this income level generates expected revolving revenue that exceeds the expected default loss by the margin required to justify the acquisition cost. The limit was a revenue calculation. It was disclosed as a credit line. The terms are in the Schumer box on page 3 of the application. The Schumer box is a federally mandated disclosure table named for the senator who championed the Truth in Lending Act amendments requiring it. The APR after the introductory period is 24.99%. The penalty APR is 29.99%. The minimum payment formula is 2% of the balance or 25, whichever is greater. All of this is disclosed in 8-point type. In a format designed for regulatory compliance, the compliance is real. The comprehension it produces is not the comprehension it would produce if the information were presented differently. The format was not chosen for comprehension. It was chosen for compliance. The distinction was always intentional. The shift. The first statement arrives at the end of month one. The balance is $3,147 from the spending required to earn the welcome bonus and the ordinary spending of the month. The minimum payment is $76. The 0% is still in effect. The $76 reduces the balance to $3,771. Everything is working as described. Everything is working as designed. These are the same statement. They will not feel like the same statement for 14 more months. The first rule. The pre-approval was not a finding. It was a selection. The model identified the profile most likely to generate revolving interest revenue across a projected customer lifetime and mailed the envelope. The envelope had your name on it because the model had your profile before you knew the model existed. The welcome bonus was priced against the lifetime value projection. The 60,000 points cost $600. The projected lifetime revenue is $2,000. The approval was the opening entry in an accounting you were never shown in full. The accounting was always going to run longer than the introductory period. The points notification arrives before the receipt prints. 340 points on a $340 grocery purchase. The notification is designed to arrive in real time because real-time reward delivery produces stronger behavioral reinforcement than delayed delivery, and stronger reinforcement produces more spending, and more spending produces more interchange revenue, and more revolving balances and more interest. And the entire revenue model of the rewards program scales. With the immediacy of the dopamine the notification delivers. The notification was not designed for your benefit. It was designed for your behavior. Both things can be true simultaneously. The machine understood this before it sent the first notification. The interchange fee is 2.5% on every transaction. On the $300 to $40 grocery purchase, the supermarket pays $8.50 to the bank that issued your card. The supermarket does not absorb the $8.50. It distributes it across its pricing. The $340 grocery purchase costs $340 because the pricing already includes the interchange cost for all payment methods, including cash. The cash customer pays $340 and receives no reward. The credit card customer pays $340 and receives $5.10 in cash back at 1.5%. The net transfer from the cash customer and the non-rewarded card customer to the rewards cardholder is real. The transfer from the rewards cardholder to the bank is $340 per transaction before interest. The reward is funded by the transaction it rewards and by the customers who receive no reward for the same transaction. The category bonus is 3x points on dining and 2x on travel and 1x on everything else. The category structure was not designed around your spending preferences. It was designed around the interchange rate schedule. Restaurants and travel merchants pay higher interchange rates than grocery stores and utilities. 3x points on dining costs the bank more in reward liability and generates more in interchange revenue. The category bonus directs your spending toward the merchants who pay the bank the most per transaction. The direction feels like a benefit calibrated to your lifestyle. The calibration is to the interchange schedule. The transactor is the cardholder who pays the full balance every month. On $2,000 in monthly spending at 1.5% cash back, the bank pays $30 in rewards and earns $50 in interchange for a net margin of $20 per month. The transactor is profitable. The transactor is not the target. The transactor is the model used in the marketing material. The marketing material shows the transactor's experience because the transactor's experience is the one worth advertising. The shift. 55% of American cardholders carry a balance month to month. The average revolving balance is $6,194. At 24.99% APR, the average revolver generates $1,547 in annual interest revenue. The rewards program is funded by this cardholder. The lounge access is funded by this cardholder. The metal card is funded by this cardholder. The 60,000 point welcome bonus you received was funded by a revolver who has been carrying 6,194 at 24.99% for long enough that their interest payments have covered your acquisition cost and your welcome bonus, and the bank's operational overhead, and produced a margin. The reward is real. The person who funded it does not know they funded it. The accounting was never presented simultaneously. The aspirational tier is the $550 annual fee card, the Sapphire Reserve, the Platinum card, the card that arrives in packaging that weighs more than a standard envelope and communicates before it is opened that the contents are different. The $550 requires $15,000 in annual spending to break even on the stated benefits. The stated benefits include a $300 travel credit and lounge access, and a $100 global entry fee reimbursement. The cardholder who spends $15,000 a year and optimizes every benefit breaks even. The cardholder who carries the card for the status and uses the lounge twice and forgets to claim the travel credit does not break even. The bank modeled both cardholders. The bank priced the card for the second one. The second rule: the reward program returns 1.5 cents of every dollar to the transactor and retains the rest. The retained margin is funded by the merchant who raised prices to cover the interchange and by the revolver who pays 24.99% on a balance that grows while they make the minimum payment. The reward is real. The full accounting of who pays for it is never presented. At the moment the points notification arrives, the moment was designed to not include the accounting. The design was intentional. The intention was the revenue. The introductory period ends on month 16. The balance is $20,400, not because spending continued at the same rate, because the $4,000 in welcome bonus spending and the ordinary spending of 15 months left $20,400 that was not paid in full before the rate activated. The rate activates at 24.99%. The minimum payment this month is $48. The interest that accrued this month is $49,998. The payment of $48 does not reduce the balance. It increases it by 1.98. This is the first month the minimum payment has been insufficient to cover the interest charge. It will not be the last. The amortization table was not included in the application. It was not included in the welcome packet. It is not on the statement. The table exists. It shows that $20,400 at 24.99%, paying the minimum payment each month, takes 11 years and 3 months to retire, and costs $3,180 in interest for a total repayment of $5,580. The table is not on the statement because the Truth in Lending Act does not require it on the statement. The Act requires the disclosure of the APR. The APR was disclosed on page 3 of the application in the Schumer box. The disclosure of the APR and the disclosure of what the APR produces across the life of a minimum payment schedule are different disclosures. Only one is required. Only one was made. The minimum payment formula is 2% of the balance or $25, whichever is greater. The formula produces $48 on a $20,400 balance. The $48 feels manageable against $2,400. The ratio communicates progress. The progress is an illusion generated by the ratio. The bank did not design the 2% formula because 2% represents meaningful debt retirement. It designed the 2% formula because behavioral research demonstrates that minimum payment amounts set below the monthly interest charge maximize the interest-generating life of the balance. Below the interest charge, the balance grows while the payment is made. The growth is slow enough to not register as growth. The slowness is the design. The balance transfer offer arrives in month 6 of the revolving relationship. 0% for 18 months, 3% transfer fee. On $2,400, the fee is $72. The offer is mathematically superior to the 24.99% APR. The offer is also an acquisition mechanism for the receiving institution and a retention mechanism for the current one. The cardholder who transfers the balance opens a new account, establishes a new spending habit during the new introductory period, and arrives at month 19 with a balance on the new card and an open account with available credit on the old one. The balance transfer solved the immediate interest problem and replicated the structural condition that produced it. The credit utilization is 28.2% on a $8,500 limit with a $2,400 balance. The threshold the scoring models penalize is 30%. The cardholder managing to stay below 30% without knowing exactly why is managing to a threshold they were told exists but not told why it exists or what crosses it or how the crossing affects the downstream cost of a mortgage or an auto loan or an insurance premium in states where insurers use credit-based insurance scores. The credit card balance at 28.2% utilization is 3 purchases away from affecting the cost of products and services that have no visible connection to the credit card. The connection was not disclosed at application. The disclosure would have changed the decision. The decision was not supposed to be changed. The statement design was not made by a graphic designer, optimizing for reader comprehension. The minimum payment is in large type. The current balance is in smaller type. The total interest paid year to date is in the smallest type in the document. Academic research published in 2009 and replicated across multiple subsequent studies demonstrates that displaying the minimum payment prominently anchors the payment decision to the minimum amount for a statistically significant portion of cardholders. Cardholders shown only the statement balance without a minimum payment suggestion pay significantly more. The statement was designed after this research existed. The design incorporates its findings. The shift, the debt normalizes in month 14. $400 is no longer a balance to be resolved. It is a condition to be managed. Conditions are managed differently than problems. Problems are solved, conditions are accommodated. The accommodation is $48 a month. The $48 arrives on the first of the month with the cable bill and the phone bill and the streaming subscriptions. It is a line item. Line items are not resolved. They are paid. The paying of it every month on time means the credit score does not decline. The score's stability confirms the management is correct. The management is the revenue. The third rule. The minimum payment was not designed to help you retire the debt. It was designed to maximize the interest-generating life of the balance. The 2% formula is a revenue optimization function dressed as a convenience. The convenience is real. The optimization was always the purpose. The $3,180 in total interest on a $2,400 balance does not arrive as $3,180. It arrives as $48 every month for 11 years and 3 months. The increments are too small to feel as the cost they collectively represent. The smallness was designed. The late fee is $30 the first time, $41 every subsequent time within 6 billing cycles. The fee is triggered by a payment arriving 1 day late, regardless of the balance size or the payment history preceding it. A payment due on the 14th arriving on the 15th generates $41. The $41 is not a penalty calibrated to the cost of the late payment to the institution. The cost of processing a late payment to the institution is approximately $1.50. The $41 is priced at the regulatory maximum the Credit Card Act of 2009 permits. The act was designed to protect consumers. The $41 is the protection. $14.5 billion in late fees were collected by U.S. credit card issuers in 2022. The fees were not a windfall. They were a budget line. The penalty APR activates at 29.99% after a payment is more than 60 days late. The penalty applies to the existing balance and all future purchases. It is not temporary. It remains until 6 consecutive on-time payments are made. On a $4,200 balance, the standard APR of 24.99% generates $1,049.58 in annual interest. The penalty APR of 29.99% generates $1,259.58. The difference is $210 annually paid by the cardholder whose payment arrived 61 days late once. The late payment was 1 day past the 60-day threshold. The additional $210 annually is the cost of 1 day. The cost of 1 day was always $210. It was disclosed in the Schumer box. It was disclosed in 8-point type. The credit limit increase arrives as a notification in month 18. Your credit limit has been increased to $11,500. No application was submitted, no income verification was conducted. The increase was extended because behavioral data identified the utilization approaching 78%, and historical data demonstrates that cardholders offered a limit increase at high utilization, draw down the new capacity within 90 days, at rates significantly higher than cardholders offered increases at low utilization. The increase was timed to the moment of maximum willingness to use it. The notification described it as a reflection of your excellent payment history. The payment history was the qualifier. The timing was the strategy. The $130 billion is the annual interest and fee revenue generated by the U.S. credit card industry. $90 billion from interest, $40 billion from fees. The revenue requires the balance. The balance requires the minimum payment. The minimum payment requires the cardholder to believe they are managing the debt. The belief is the load-bearing element of the architecture. Without the belief, the balance is recognized as a problem and resolved. With the belief, the balance is recognized as a condition and managed. The management generates $90 billion in interest annually. The belief generates the management. The machine generates the belief. The machine was designed to generate the belief before it was designed to generate anything else. The credit score functions as the control mechanism that extends the architecture beyond the credit card relationship. The score affects the mortgage rate. A 724 versus a 760 on a $380,000 30-year mortgage is approximately 0.5% in rate. 0.5% on $380,000 across 30 years is $42,000. The credit card balance at 28.2% utilization that suppressed the score from 760 to 724 costs $42,000 on a mortgage the cardholder will take out in 4 years on a house they have not yet purchased. The connection between the credit card balance and the mortgage rate is real. The connection was not disclosed at application. The disclosure would have changed the calculation. The calculation was not supposed to be changed. The behavioral data is 40 years old. The first general-purpose credit card was issued in 1958. The data on spending behavior, payment timing, balance transfer response, default probability, and revolving likelihood has been accumulated, refined, and operationalized across 4 decades of mass-market credit card issuance. The model that sent the pre-approval mailer is the output of 40 years of learning about exactly the person who opened it. The envelope was designed for the person it was addressed to. The design has been refined across every iteration of every campaign that preceded it. The refinement is the product. The product works, the shift. The middle class is not the credit card company's customer. It is the credit card company's product. The customer is the shareholder. The shareholder receives the $130 billion in annual revenue net of acquisition costs and reward program expenses and default losses. The middle class generates the $130 billion. The generation requires the balance. The balance requires the minimum payment. The minimum payment requires the belief that $48 is management. The belief was installed by the statement design and the notification timing and the introductory period and the welcome bonus and the weighted envelope with the name printed on the outside. The installation was not accidental. It was the product. Somewhere right now, someone is opening an envelope with their name on the outside. The offer is 0% for 15 months and 60,000 points and $4,000 in spending in 90 days. The envelope arrived because a model ran a profile and found a match and printed the name and calculated the lifetime value and determined that the $600 in welcome bonus and the $150 in acquisition costs would be recovered with margin. The person holding the envelope will apply. The approval will arrive in 60 seconds. The points will come. The introductory period will run. The balance will remain when it ends. The minimum payment will be $48. The $48 will feel manageable. The statement will show the minimum in large type and the balance in smaller type and the year-to-date interest in the smallest type on the page. The machine approved this person before they opened the envelope. It approved them when it printed their name. It approved them when it built the model that found them. The model has been running for 40 years. It knows what happens next. It always did. It always will.